All right, guys. Good day, everybody. It's Dr. Banks here again, and then I want to welcome you to the fifth session of our SMC studies, and as we try to further expand the concepts that we will be forming our trade plan or trade style, the concepts of smart money, the concepts that are embedded inside of the smart money concept, the sub concepts that are embedded inside of the smart money concepts. And then we have tried to look at the concept of market structure, and we have tried to look at the concept of external liquidity. And today we'll be talking about internal liquidity. I will try as much as I can to make this as simple as I can, but as comprehensive as I can. Okay, if you had looked through the last video that I sent on the platform earlier, where we talked about external liquidity, and then I would not be dabbling into that today because the material is still available on the page, so you can just look that up before you see this. Okay, so today I will be dealing closely with the concept of internal liquidity. Okay, and then I mentioned when I introduced the concept of liquidity that inefficiencies or fair value gaps or imbalances are the only forms that I consider as internal liquidity, okay? Because they actually happen in between candles. They happen inside of the structure. They do not happen outside the structure, okay? So they happen in between candles. So I consider them as internal liquidity, as the name implies, okay? So imbalance or inefficiencies are seen when price creates a fair value gap. Okay, the simple question is, what is a fair value gap? And I said, simply put, when the open of a candle, I call that candle 1, does not meet the close of candle 3 or vice versa. Okay, so let's call this young man candle 1. Okay, 1, sorry. Okay, and call this candle 2, right? And call this candle 3. All right, now this wick up here, I would address that as the high of this candle. Okay, and then it failed to close the low of candle 3. Okay, thereby creating a fair value gap. The fair value gap is the difference between the high of candle 1 and the close of candle 3. Okay, so this becomes another candle 1, very subjective, and the one after the middle becomes candle 3. So candle 1 again, candle 3, high refused to close the low of candle 3. All right, this candle 1, this candle 3. Okay, so candle 1 here, candle 3, candle 1 high did not close the low of candle 3. By so doing, creating fair value gaps, okay, which is not the actual move of price. Price was made to mitigate each other. Candles were made to close in on each other. Okay, that is how candles were designed to function. So it means wherever we have an imbalance, price must come back to rebalance, and inefficiencies must be revisited to be made efficient. Okay, fair value gaps must be refilled, imbalances must be rebalanced, inefficiencies must be revisited to make price efficient. Okay, so it means that wherever we have inefficiencies in price, price had escaped that zone for whatsoever reason with a strong momentum and had failed to mitigate the previous candle before the mid candle. By so doing, causing these gaps, causing these gaps, causing these gaps. And these gaps are what we call our internal liquidity. Because, like I said, liquidity is the fuel, liquidity is the gas, liquidity is the energy. It is what forces price to move. It is what helps price to move. It is the drive. It is the vibe that gives, it is the vibe that price has to move. Okay, so when price needs ginger, when price needs energy, when price needs to move, what price does is to seek liquidity and tap into liquidity, gain momentum from liquidity and move. Now, liquidity may either be internal or external. And I talked about external liquidities as old highs, as old lows, as trend line phantoms, as equal highs, as equal lows, as all of those things I talked about as external liquidity. And then today I am trying to explain the concept of internal liquidity. And I've mentioned again that inefficiencies are the only internal liquidity that I consider as internal liquidity. Okay. Now, without wasting much of our time, I would like us to jump on the charts very quickly so we can actually see how this looks on the charts. Like I said, it is just the difference between the high of candle 1 and the close of candle 3, or the close of candle 3 and the high of candle 1, or the close of candle 1 and high of candle 3, as the case may be, depending on the trend, either uptrends or downtrends. And I mentioned that price will always seek liquidity before continuing to the upside. Okay, so let's assume that we had some, all right, let's jump on the charts very quickly. Let's jump on the charts very quickly. Okay, I'll have to mute all of this on the background. Give me a minute. All right, great. So this is Euro USD 4-hour time frame. Euro USD 4-hour time frame, and then very quickly we would be, all right, let me get somewhere in nice position we could work with. All right, great. So like I mentioned, it is the difference between, this is the low of candle 1, okay, and then this is the high of candle 3, okay. Now this gap inside here is what I refer to, or is what we refer to as inefficiency or imbalance or fair value gap within the smart money space. Okay, so what is price do? We had continued printing lower highs and lower lows already, as you can see, before this was formed. But when this was formed, price came back in, tapped in liquidity, internal liquidity, to fill in this gap. And then I told you that old highs are a form of external liquidity. So what did we do? We also took out old high liquidity that was sitting above this level. Okay, we took out liquidity that was sitting above this level after filling in internal liquidity, and then we continued bearish. Another instance over here, right? We had this level as the close of candle 1. Let's extend. Boom. And we had this level as the open of candle 3. Okay. And then we had continued forming a range structure, if I should call that a range structure, below this level already, below where we have inefficiency. Okay, but what did price do? We came back to revisit this level, to close in on inefficiency, close in on the fair value gap. The essence is to rebalance the imbalance, or to make inefficiency efficient, or cause proper efficient move in price. And then what we did here was to mitigate this block, which now became the new POI or supply level. And then we continued to the downside. Nice delivery to the downside. Okay, let's see if we can get something else on price. All right, great. Another scenario, quick scenario. We had this level here and this level here as an inefficiency. Price came back to fill, mitigate, and then we tested the zone inside of here, right? And then we continued to print lower prices. Okay, trying to get more, trying to get more, trying to get more. Trying to get more, trying to get more. All right, good. So we have this guy here as inefficiency. Okay. Now, I'm not trying to discuss the logic behind these, I'm only trying to show you how price behaves around inefficiency, and then buttress the fact that imbalances should be rebalanced according to the behavior of price. Okay, so we had price continue back to fill this place, right? And then mitigate this block. Okay, this was our order block, right? When I go into details, you understand why I would rather work with the highs, okay? The wicks rather of these points. And then we experienced this minor move to the downside. The essence of that move was also to close in on inefficiency that was created between this guy here and this guy. Though we did not mitigate fully, but then we tapped into the internal liquidity of this inefficiency, and then we could see further prices to the upside. Okay, so let's see if we can see other examples to this side, and then we would continue. All right, inefficiency is being filled. Inefficiency, right? Inefficiency. Okay, so price continued back in the range to closing on this. Now, inefficiencies can either serve as entry points or as targets. Okay, we can use them as entry points or as targets. All right, now this is a situation where inefficiency was used as an entry point. Okay, we have this zone here, right? And we have this guy over here. I hope you can see this very well. I don't need to zoom in. And then if you can see what happened, price came back in to close in on this inefficiency, tap in on liquidity, and then tap into this level of demand, okay, that was formed here. And then we continued to see further push to the upside, okay? We continue to see further push to the upside. There was also an inefficiency here. The price went back to rebalance, okay, an imbalance here. The price went back to rebalance. And as well tapped into this block to enable us see lower prices to the downside here, where we had to fill this before continuing with the trend. Okay, I'm trying to get extra confluences. Okay, now gaps are also internal liquidities. Okay, gaps also serve as, like I mentioned, fair value gaps. Now, if you look in between here, there is no candle at all inside of here. Okay, it is called a gap. And then in currency trading, this also serves as internal liquidities. Okay, they are also fair value gaps. And then they have to be filled before we have the continuation of price to the downside. Okay, now, all right, let's do this very quick. So we had this level here, right? This is another instance where price served as an entry or as a target for those who were selling from the top. So this guy from here to here, the open of this candle, the high of this candle to the low of candle 3, we have this huge imbalance or inefficiency inside here. Okay, so what did price do? We came back here to close this, tap in on liquidity inside of here, but as well mitigate this level of demand. Okay, mitigate this level of demand. Our next topic coming up should be demand and supply. So I'll get to talk about all of this. Okay, mitigate this level of demand, and then went back up. Now, what did it go back up to do? There was also an inefficiency or imbalance between this guy, right, and this guy. So we went back up to refill that, grab liquidity, and then mitigated this block here, which was our new supply block. And then we continued to the downside. Okay, I can still see another example here where inefficiencies could have served as a signal for an entry, because this candle is an IFC candle. Okay, this is an order block. And then we have this and we have this. No matter how small it looks, we did not get proper mitigations. Okay, and then price continued back into the level to tap in on this guy here. And then we saw further prices, further bearish movements to the downside. Okay, this is also an inefficiency. Okay, from here to here. Okay, and then because of order flow, we just filled in on this and then reacted a bit and continued upward. Okay, let's get more. All right, great. Price had created an inefficiency on its way down between this young man over here, Mr. 1, and then Mr. 3. Okay, so what did we do? We came back to refill this area, tap into the inefficiency, the internal liquidity that was created by inefficiency at this area, and then we saw price continued to move bearish. Okay, I'm still trying to get more for us. Okay, now let's say this again one more time, where price filled in on inefficiency. This could have been candle 1, and then this would be candle 3. Okay, it's actually one of the most simple concepts inside of the smart money concept. Okay, so we closed in big, right? We actually created inefficiency between this guy and this guy. So we can feel the inefficiency between this guy and this guy, tapping on the block. And then we went back here to feel this inefficiency. And then we continued to the downside. Okay. Now, price must not actually feel every inefficiency. Okay, it solely depends on the order flow. Yes, they may be filled, but may be filled at a later date. Okay, so the inefficiencies or the imbalances that will be filled almost immediately would depend on the order flow and the movement of price at that time. This is another young man here, right? And we have candle 3 here. Okay, so we broke below, but what did price do? We went back in to close in on this huge gap that was created by plans to rebalance imbalance, and then mitigated this block here and continued to the downside. Okay, I think let's get 2 more examples and then I'll be done. All right. Inside of here, we still have another guy that was mitigated. This here and this here. Okay, so price came back down to tap into internal liquidity. Like I said, liquidity is the fuel for price. For price to move, price has to tap into either internal or external liquidity that should sponsor further price movement. Okay, so this was this here, and then it mitigated this demand block. Okay, and then it continued to push to the upside. Another example, they are everywhere on the charts, This guy here, okay, and the close of this guy was actually our liquidity. Okay, so our price came in here but failed to mitigate fully or retest on this block, hence this move back to this area, and then we had closed in on this block completely, and then we saw further price move to the upside. Okay, let's get more. I know you can see these other ones I see on the charts, but I'm trying to get the ones that serve as entries. Okay, and then I'm excited you can see them as well. So let's get more. They actually list everywhere on the charts. So I'm trying to get the ones that are actually very key to what I am talking about. All right, great. So this was another one. This guy here, okay, formed an imbalance with this guy here, okay? And though we had seen price pierce in, the essence of this long movement was just to fill in on this gap, because that's the movement of price, was just to fill in on this gap and then tap into liquidity that should cause further movements, okay? And then we failed to mitigate properly, hence this young man here, okay? Hence this young man here, okay? So this guy came to fulfill the mitigation, and then we had continuation to the upside. Okay, I think I saw something over here. Yes, great. Now we had created an inefficiency inside of this area. Okay, we have inefficiency here, we have inefficiency here, we have inefficiency here, we have inefficiency here. Okay, so price went in, tapped into that inefficiency, absorbed external liquidity above old highs, right? And then we saw price push down to tap into internal liquidity and push up again, came back to the zone, and all of those movements. Okay, so I believe I have been able to help you understand what inefficiencies actually look like and how price continues to rebalance or fill open gaps or vacuums. Okay, like I said, I'm only introducing these concepts to you and helping you see what they look like on the charts. Okay, I want to believe that within this month or in the coming months, I will finish up with every concept I have to teach you guys on SMC, and then we can continue marrying them. Okay, we can continue marrying them and create confluence out of them. And then we will talk about top-down analysis, okay, and how to do top-down analysis using the SMC concept. But for the meantime, I want you to begin to get on your charts, and I want you to begin to spot out inefficiencies. All the concepts I've taught you, spot out inefficiencies, spot out equal lows, spot out old highs, spot out all of those things and see how price reacts to them. And then in our next class, we'll be talking about supply and demand. So I wish you guys an amazing trading week. Do have a great day.